Feroze, what about you? I mean, what comes to mind as you go back to client conversations, interactions, and everything that 2025 threw up?
I personally think there are about 4 or 5 things which have really gone down as a learning for me. I can take you through them during the show, but I think the first one I'll start with is courage pays off. Courage pays off, and I don't believe that equity has not delivered. Why? Because gold, there is only one price. At best, you will say 22 carat, 24 carat. Silver has one price, right? Debt has largely very narrow 7-8% kind of a return. Real estate is a divergent asset class. Equity is the most divergent asset class. I have a client portfolio which has done 18% last year. There's a client portfolio which has done 5% last year.
Okay.
Both operate in the same India. What distinguished? They have the same goddamn advisor, right? Or a distributor. But the difference in performance is because of courage, not because of my company's great advice or something. Right? One guy, in equity markets gave you 3 opportunities this year.
To buy.
Then
one was, right?
Before that also, during the budget and post that, on 8th or 9th of March, we saw 22,000 again. I went on a couple of channels and said, if I have 1 more years of bonuses coming, I would leverage and advance my payments. Because if I get 10%, 12% correction, almost 15% correction from peak, now I wanted Nifty at 0. What am I waiting for? Right? So I think exhibiting courage rationally, mathematically, pays off. And I'm not buying some Sartoria stock. I'm buying mutual fund. Now their courage complemented with a risk-free, low risk instrument in equity works very well. So first learning is don't go by the headline number. You can still make money in equity because equity implies 6,000 stocks, 900 mutual funds.
So then where do you stand on the active-passive debate, the right mix now?
Passive, I wrote off active practically. If you saw any of the shows in 2019, my model portfolio had underperformed Nifty by 9% in 2018.
And it was largely based on active funds.
It was all active funds.
Yeah.
So the kind of hammering I got from my clients, I itself said, "Yaar, ye active chhod do, agar naukri rakhni hai." Right? This is the kind of mentality. And then I was almost gearing towards that and saying that passive is the way to go. 2020 came. I made alpha of 12%. Then came 2021, alpha of 8%. 2022, negative alpha of 4%. 2023, FY24, okay, large part of FY calendar year 23 because I see FYs, 14% again, beating Nifty. So this has happened several times that you almost say that this year says that actives are over. There are 4 or 5 years. Just go look at the data. Worst active years. Worst time where out of the 967 total funds, 665 active funds, any year where there were minimum beating, the next year could have been the year back for active. And then when I backward calculated what is making this happen, in years where FI outflows are there, becomes difficult for active to beat it. Right? That's one thing which seems like a hypothesis worth testing. I'm still testing.
So right now, what are you saying between active and passive?
I'm saying active will be very, very good.
Feroze, why I think despite this big gold rush, you're still keeping the faith more in equities. And give us the counter view. I think that you've never been too much in favor of gold, but will some allocation, is that required?
See, I don't like some. I do either decisive decisions or don't.
Okay.
Because if you have debt in your portfolio, gold is 100 times better than debt. I've said this numerous times.
Okay.
My clients, if I manage 90,000 crores of assets, only 3,000 crores is in debt because that's for short-term money to be paid by my 12,000 client families. If I had 30,000 debt, be rest assured I would have had 15,000 of gold. Because gold can hands down beat debt. That's what data says. Rolling return of gold, 10-year rolling return, 1-year rolling return, I have all that data. The probability that gold beats 12% on a 10-year basis, rolling, not today, not 10 years of the exact past, rolling 10 years, is only 13.73%. If there is only 13.73% of rolling return of 10 years of beating 12%, do I have to say that equity will beat in the long run? It will. I put the same litmus test on equity, okay, which is Nifty. Nifty, that is 57.81%. If one has 57, 56, 58% probability, the other has 13 for a long-term investing, how do I go against math being the CFO of the client? Second, now comes, should there be gold? Can gold be a hedge? Now, I tested that hypothesis.
Okay.
We listed down in the last 20 years, how many months has Nifty been negative? There are 103 months where Nifty has been negative. In those 103 months, how many of the months was gold positive?
Okay.
That is 66. So 2/3 of the time, when Nifty was down in the dumps, gold was positive. So does it have a hedging ability? Which 10 years back, if you asked me, I was shooing away gold as a hedging capability. But after looking at this data, I correct myself that it has the ability to hedge.